Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This Analyze Out Loud video is going to be on the best performing dividend aristocrat over the last 20 years, Roper Technologies. Roper Technologies is an industrial conglomerate that operates in several businesses. It has medical and scientific imaging technology, radio frequency or RF technology and software, industrial technology, and energy systems and controls technology. As a result, this is not a household name, so to speak, but as I previously stated, it has been the best performing dividend aristocrat over the last several years. But there's a couple of things about this that I think are interesting. Number one is I'm going to take a look at this company primarily through EBITDA per share. Because as you can see on this graph here, EBITDA is where you get the best correlation to price. Going back to 1999, this company has traded at about 11.7, we'll call it 12 times EBITDA historically. It's currently trading at 17 times EBITDA. So as I indicated in the written portion of this article, it's not just to know what the performance of your stock has been over time. It's equally as important to know how and why that performance came about. So let's examine that a little bit. Number one, the company has grown EBITDA at almost 14% a year, and it's been very consistent. But I want you to notice how the price tracks the company's EBITDA. And of course, this was the Great Recession, which created a swoon in stock prices for most companies. But the company has a really good long-term growth record, and it's been very consistent. Their dividend record is also interesting. As I pointed out, they are a dividend aristocrat. However, I want you to notice that their payout ratio is very low. If we look at the company's long-term performance over this time frame, had you invested $10,000 in December of 1998, it would be worth $269,000 in capital appreciation alone. The company would have paid $9,412 in dividends over that time frame and generated a total annualized rate of return of 18.6% per year. But again, you can see that it substantially outperformed the S&P on a capital appreciation and a total dividend income. What I find most fascinating about this particular dividend aristocrat is that it is primarily a growth stock. Notice that the dividend payout ratio is actually historically averaged very low, 11, 10, 12, 13, 15%. Now, I do want you to notice something. It looks like there was a dividend cut on this particular graph in 2003, but that's really not true. It's a result of the company switching from a fiscal year end of October to a fiscal year end of December, so that kind of skewed the actual reported result a little bit. But but the reality is they've increased their dividend every year, and notice that they've paid a very high level of dividends over this time frame. In order to put this into perspective, what I've done here is brought up the historical performance over the same time frame for the AAA rated blue chip dividend aristocrat Johnson & Johnson. And I want you to notice that Roper actually paid more total dividends than Johnson & Johnson, even though their dividend payout ratio has been significantly lower than Johnson & Johnson, and that their yields have typically been higher. They also generated significantly greater capital appreciation. Nevertheless, the point I'm making here is that Roper is almost more of a growth stock than it is a dividend aristocrat, although it has had a very enviable historical dividend record with dividend growth averaging 14.1 or 15.4% and a compounded annual growth rate of 14.1%, which is very, very close to their adjusted operating earnings growth rate that I'm showing here on the graph right now. Now, as I switch from EBITDA to operating earnings growth, I want you to notice that the correlation to EBITDA was very profound. On earnings, this is a company that the market has typically valued at a very high valuation, but there's a couple of aspects about this company that I found really intriguing when I was doing my research. In addition to a high correlation on price to EBITDA, there's also a very high correlation to operating cash flow. But I also want you to notice some things about operating cash flow versus free cash flow. And to do that, I'm going to switch to FundGraphs, the financial underlying numbers. What I really want you to see here is that their free cash flow is almost as high as their operating cash flow. In other words, most of the operating cash flow this company generates is actually free cash flow, which has been, in my view, one of the reasons why this company's been able to grow as consistently as it has. One of the reasons I point this out is, again, if you think of this company more of a growth stock than you do a dividend growth stock, although it's clearly both, it's because this company has been aggressively making acquisitions. This is a slide in a recent May presentation where they talked about they deployed $9 billion in acquisitions over the last 7 years. That's from 2011 to 2017. And you can see where they made those acquisitions. But the point is, because their operating cash flow is primarily free cash flow, they have the ability to make these kind of acquisitions and still pay dividends to their shareholders. Now, before I go on, let's look at a few other aspects of the company. Its current dividend yield is only 0.6%. And again, that's because the valuation is high. I think it's striking to look at this graph and see how this company is traded at around a 12 times EBITDA all these years. But then more recently, as we come into this highly valued market we have right now, especially a lot of the dividend aristocrats, that valuation has gotten so high. It's been trading at 17, 18 times EBITDA over the last several years. Now, if I shorten the graph, the EBITDA growth has been actually a little higher here. It's growing at around 11%. And so from this point of view, the valuation doesn't look quite as dramatic as it does when we look at the long-term graph. But again, it's something that I think you need to be aware of, that what we have here is a significant amount of long-term growth, especially operating cash flow, which I showed you, and free cash flow, which I showed you a moment ago. And that growth has translated into a very high valuation. So this stock, no matter how you measure it, is fully valued today, if not overvalued. But a lot of the rate of return has come from these high valuations. So I'm going to go back and look at forecasting, or down here and look at forecasting for a moment. The company is expected EBITDA at about 8% a year over the next year or so. The long-term trend line growth, with only 2 analysts making the forecast, is about 12.5%. So this company is expected to continue to grow, but we now have a high level of valuation. What I'm really trying to get across here is, I think it should be obvious as you examine this graph over the long run, that this is a terrific company. You know, it's BBB plus rated, has about 36% debt to capital, but it is trading at a premium to its historical normal valuation levels, which has contributed to the great performance that the company has achieved over this time frame. The earnings growth and the EBITDA growth and the cash flow growth has been phenomenal, but the company has also now become fully valued, and that to me is beginning to become a concern. That's why I said in the title of the article, I think this is a great business. I think it's a great dividend aristocrat, and it's one that I would like to own if I could buy it at a reasonable price, but I don't think the price is reasonable today. If you look at it from a standpoint of earnings yield, even though the market has perennially priced this at a very high multiple of earnings, the multiple has gotten high enough now. It's trading at 26.5 blended PE ratio right now, relative to a norm of about 22.9. So it's not crazy here, but this stock is certainly not a bargain at these levels. But the real key is, I wanted the reader to understand that when you're evaluating the performance of a stock, it's important to know what and where and how that performance has happened. In this case, it's happened by generating very above average consistent growth. It's happened by generating a lot of operating cash flow that translates into a lot of free cash flow that allows them to continue to make acquisitions and yet continue to grow their dividend over time. But it's also a stock that is all of a sudden become premium valued. So it's a great stock. It's a great dividend aristocrat. I just think it's fully valued at these levels. This has been Chuck Carnival saying thanks for watching.